Last night, the government handed down the federal budget, and this is arguably one of the most important budgets we've had in decades. With the economy in a recession, government deficits at an all-time high, and COVID-19 still running riot, this really is a very important time for our economy. So today I want to summarise the aspects of the budget that I think are important for you, and just bear in mind that all of these changes are proposals and they need to go through Parliament in order to become law. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video, and today we are talking about the 2020 federal budget, which was released yesterday. Probably the most exciting part of this budget is the tax cuts, and these are the same tax cuts that were proposed in last year's budget as stage 2, but the good part is they've been brought forward. These two tables outline the difference between the current tax rates and the new tax rates. So in summary, the 19% tax bracket is increasing from $37,000 to $45,000, and the 32.5% tax bracket is being lifted from $90,000 to $120,000. In addition, the low and middle income tax offset will be retained for an additional year, and the low income tax offset will be increased from $445 to $700. To give you an idea of how this will help, this table outlines the potential tax savings when comparing the current tax rates with the new tax rates. So the people that are set to benefit most from this really are the low and middle income earners. As you can see, the tax saved in comparison to the tax payable is the highest percentage. Those guys that earn the big bucks will still save some tax, and the amount saved will be capped around $2,565. Now, the exciting part of these tax cuts is that they're going to apply from 1 July 2020. And the reason why that's exciting is because for the last 3 months, we've all been paying too much tax. So when these new tax rates do come in November, it means that your PAYG is going to reduce from that point onwards, and it's going to be like an instant little pay rise. In addition, if you've been paying more tax than you have to for 4 months of the year, when you lodge your tax return at the end of the financial year, you're more likely to get a tax refund. Now, obviously, everyone's situation is a little bit different, so a tax refund is not guaranteed, but all else being equal, you should get that extra tax paid in those 4 months back. Now, I'm a big fan of these tax cuts because it means more money in your pocket. And can I suggest that when you do get the benefit of these tax cuts, you put the money to good use. So maybe you do a little bit extra super contribution, or maybe some debt repayment, or maybe an investment plan. Use the money wisely. The stimulus payments continue for some eligible welfare recipients. There will be 2 payments of $250 each, one paid in December this year and one paid in March next year. In order to be eligible, you need to be in receipt of one of the following: age pension, disability support pension, carer payment or allowance, family tax benefit, a pension concession card, Commonwealth Seniors Healthcare Card, or people who are eligible Veterans Affairs payment recipients and concession card holders. Not much more to say on this one other than enjoy. If you're unfamiliar with the First Home Loan Deposit Scheme, it's a way for first home buyers to purchase a house with less than a 20% deposit and not pay lender's mortgage insurance. Now, this scheme was kicked off in January of this year with 10,000 spots available, which have all now been filled. And due to the popularity, the government has opened up a new lot of 10,000 spots. There's a good scheme that can potentially save first home buyers up to $10,000 in lender's mortgage insurance costs, which is massive. But putting my financial advisor hat back on, nothing beats good old-fashioned savings. If you don't have a 20% deposit to buy your first house, then there's nothing stopping you from postponing the purchase, rolling up your sleeves, and saving up some more money. Building on from previous reforms, which saw small and inactive super accounts automatically consolidated, The government is now taking this one step further and saying that every time you start a new job, a new super account will not be created. Instead, your existing super fund is going to go with you under what they call the stapling scheme, and you're going to be able to nominate which super fund you want through the Your Super portal on MyGov. In my opinion, unless you're lazy, you really should have already been doing this. There is no need to start a new super fund every time you kick off a new job. You should always look to consolidate your super where possible, and obviously take into consideration things like your insurances before you do consolidate. In addition, the government is going to be monitoring poor performing super funds and make it easier for you to compare MySuper products. Now, if a fund is a poor performer, the government may close it to new members. But again, if you just took a small interest in your super, you would know if you're in a poor performing fund, and you should have already moved out of that fund. The government is trying to make it easier for people to formalise granny flat arrangements. Now, this is currently a very complex area and can lead to significant capital gains tax implications. Under the new arrangements, granny flats will be exempt from capital gains tax provided there is a formal agreement in place. Now, I think that encouraging people to have formalised agreements is a good thing because this adds to financial security for the elderly. The remainder of the measures apply to businesses, so if you're not a business owner, then feel free to stop watching now. But if you're curious, then let's kick on. If you operate a business and you make a loss in any period up to June 2022, then you may use that loss to offset previous profits made from the 2018-19 financial year onwards. Or in layman's terms, what this means is that if you make a loss, you can use that loss to get some tax back that was previously paid. This measure really is about helping the businesses that are struggling due to COVID-19 stay afloat, and hopefully it does help a lot of small business owners, particularly in the hospitality industry. Those businesses that have had to close their door and literally make nothing, this is really going to help them. If you operate a business and you buy an asset for that business, you'll be able to write off the value of that asset in a single financial year, regardless of the price. Now, under the current rules, you can write off assets up to $150,000. Anything over $150,000, you'd need to depreciate it, which basically means that you're writing it off over a number of years. This is good news for large businesses because large businesses that have big capital outlays are likely to buy assets worth more than $150,000. However, small business owners, this probably isn't going to change your life much because a lot of small business owners won't purchase an asset more than $150K anyway. But what it will do is help to stimulate spending and pump more money into the economy, which should hopefully create some new jobs. The government is trying to incentivize businesses to hire young people by offering a credit of up to $200 per week for 12 months if you hire someone aged between 16 and 35 that are currently on job seeker payments for a minimum of 20 hours per week. The payment rate received by the employer will depend on the age of the employee, and it's broken down into two categories. If the eligible person is aged 16 to 30, the business will receive $200 per week. If the eligible person is aged 30 to 35, the business will receive $100 per week. This is a good measure to help businesses expand and create jobs, but I do worry that job creation is only one side of the equation. There also needs to be a willingness to work. And what we've seen with the increase in the job seeker payments is there's been a disincentive for people to actually go out and start working again. Also on the job front, the government is pumping some money into education and training. They are also giving a fringe benefits tax exemption for those employers that are willing to retrain and reskill workers that would otherwise be redundant. Due to COVID-19, we're expecting this budget to be a bit of a cash spend, and largely I think it's done that. More people are going to have more money in their pockets due to the tax cuts, businesses have more incentive to spend and hire new workers, and I haven't even mentioned the millions of dollars that's been spent on infrastructure, healthcare and essential services. So overall, I think this budget has delivered in a time that we need a bit of spending to help us recover from COVID-19. But that's it for me today, guys. I hope you liked this breakdown. If you did, please give it a thumbs up and I will see you guys in the next video.